In this video, I wanted to talk about synthetic or paper supply to a market. And this can relate to the Forex, the foreign exchange market, the stock market, the bond market, the futures market. I want to particularly talk about the futures market and the metals markets, particularly gold and silver. Now, in any market, you have to have a buyer and a seller in order to complete a transaction. Without one or the other, it's just not a market, it's just not going to work. And all they have to do is agree upon the price. Now, in the futures market, you don't necessarily have to have the metal to bring supply to the market. If you're a seller, you're supposed to, theoretically, you're supposed to be able to have supply. You're supposed to be able to deliver the product. But a futures market is, they're trading the promise of future delivery. So say you're promising, I'm going to deliver gold to you in September. I'm going to deliver gold to you in October, and you're at the beginning of the year. Well, that promise alone is supply. So, and all there has to be on the other end is somebody who wants to take that promise, saying, okay, yeah, I'll buy it from you at that price. But what happens is these different large institutions, and I think I've pretty well documented that we've got central bank involvement and large entities, banks working on the behalf of government, coming in as suppliers of synthetic and paper. And of course they do have physical as well. Central banks, they hold large amounts of gold, and of course banks do as well. So they do have some physical to back it up, but the amount that is traded on the market is minuscule. I'm sorry, the amount that they actually have in hand, the physical, is actually minuscule compared to the amount that's traded on the market. But it doesn't matter, because as long as somebody comes saying, I'm willing to sell it to you in the future, then that becomes supply, whether they have it at that time that they make that promise or not. So hopefully that's clear, that you don't have to even have the metal on hand in order to be a seller. I could sell, if I had enough money in my account to back up a promise, I could sell millions of ounces of silver and gold on the market, thus creating supply. And like I said, there's a lot more paper synthetic supply out there than the actual physical metal to back it up. So there's this musical chairs going around with the paper promises of gold and silver when there's only a small amount. And as long as the game's still going, it's working fine. And like I mentioned in that earlier video about the carry trade, once people start getting into it, it kind of feeds on itself, which is where we are in the metals markets. But once that reverses, you've got a dynamic where everybody who's become a seller, in order to close it out, they've got to become a buyer. And they're going to only find people who are willing to sell it then at a much higher price. So one more thing about this I want to explain is the bid stack, and the bid and the ask, and how that works, and how somebody who with intent and with lots of synthetic supply can actually push the price down and make money.